If you do well, the tables turn all the time. You have the leverage then. You have other banks competing for your business.
Dave Miller, welcome to the show. Not a lot of bankers impress me, let me tell you.
Well, most of us are pretty boring. You can essentially get 90% finance. The SBA on a change of, they call it change of ownership transaction. The SBA minimum equity injection is only 10%.
Welcome back to Succession Stories. For all the listeners who are watching on YouTube, it is evident that I am not in my regular studio. This is like a pop-up Succession Stories episode. I am so excited to be at the Enterprise Marketing Studio. We've had a great morning where I was on my guest show not too long ago, and we'll talk about that in a moment. I am appreciative of my audience's patience. We took a little bit of a hiatus in recording, and so I'm excited to be back, and I'm excited to be back with this guest. Let me tell you a little bit about him. So we met at an Exit Planning Institute chapter meeting here in Pittsburgh, and I was really impressed. Not a lot of bankers impressed me, let me tell you, but this banker impressed me because we were speaking the same language, although he's coming at it from certainly a different aspect. And that's really the crux of today's conversation is we have not had, Dave Miller, welcome to the show. We have not had a banker in 220 episodes of Succession Stories. We have not had a banker on the show. Can you believe that?
Most of us are pretty boring.
Yeah,
not
most
a
of you are
sexy
pretty
industry.
Boring. And so when I met you at the Exit Planning chapter meeting, and I followed up with you afterwards, I said, "Look, we got to talk." We were singing the same songs, and I think a big reason why is because of the focus on the lower middle market, the focus on growth, the focus on really helping enterprises. And so welcome to the show, and tell me why you are excited about our conversation today.
Well, thank you so much for the invite. It's great for me as a podcast host for our bank's podcast to be on the other side of the table. So, always interested in talking about, things that are important to small business owners, which is, the crux of what we do here at Enterprise Bank. So, to reciprocate, when we did the Exit Planning Institute panel on business acquisition financing, and I met Laurie after we had a follow-up meeting and really like her approach. And as she said, she was a guest on the bank podcast here recently. So excited to talk about kind of a little piece of the business acquisition pie, which is, how do you finance transitions or growth?
Yes, there's a lot to talk about. And I don't, because I haven't covered this topic in depth on the show, we talk about funding and things like that, but we haven't talked about it from kind of a nuts and bolts standpoint. So I thought a great place to start would be just, let's talk about lending. There's conventional loans and there's SBA. Maybe you can just give us a kind of a descriptor of what's each and why would we use them?
Okay. So, obviously, anytime we're talking about businesses using leverage or bank financing, either for growth or for acquisition, the tools, the primary benefit of using leverage is you don't have to dilute yourself versus equity investment where, I always say you pay me a fixed monthly payment as a banker, but I don't get a portion of your profits from here to infinity. So it's a great tool in the right circumstances. And when it comes to conventional versus SBA lending, conventional lending, whether it's, leveraging to expand, whether that means new facilities, new equipment, increases in inventory, those are kind of the normal kind of hard asset uses of proceeds. But in a lot of cases, working capital financing is important to grow a business too. And what so many business owners don't understand is there's really two types of working capital financing can benefit a business. One is the traditional line of credit, which helps a business cash flow, particularly a business that's selling in the B2B space where they have to carry receivables and invoices. But there's also the permanent working capital piece, which is, building an asset. It doesn't have to be a piece of real estate. It doesn't have to be an equipment. The business itself is an asset. So sometimes a permanent working capital injection through a bank or another third-party lender makes sense to scale. So I always, tell business owners, Is this a long-term investment in your business? If it is, then permanent working capital, the cash to get to the next level is appropriate. And as I said, when you're in the B2B world, having liquidity and having cash flow is king, right? Cash is king. So revolving lines of credit, and they can work very well together. Where the SBA kind of comes into play, now let me give the general landscape here. So the SBA, Small Business Administration, federal government agency, which I usually shut people off right there when they say, "Oh, I have to work with a government program." But it's one of the government programs that I think really, really works for small business. So the concept of the SBA, and I spent the small part of my career working for the SBA itself and helping banks support small business. The whole concept of the SBA program is basically the government is minimizing or mitigating the risk for banks so that banks can expand the breadth of the types of financing scenarios that they can lend into. So the SBA essentially is an insurance policy for banks at its core. So when a bank sees a great prospect, whether it's a startup, whether it's a next level expansion, whether it's a business acquisition, and it makes good business sense, but it doesn't fit a traditional lending parameter for conventional lending. It could be that it's a type of business, it's a service or people-based business, doesn't have a lot of hard assets as collateral for a bank. It could be a business that is relying on what will happen, not what has happened from a cash flow perspective, where you're lending into a business plan or projections. And that's not just for a startup. That could be a business that wants to open a new product line, wants to open a new division, wants to scale up. That SBA, that government guarantee is what it's called, that insurance policy from the government to support the banks just allows the banks to take a little more risk in scenarios that don't fit traditional conventional lending parameters.
So let's unpack a little bit. So let's say I'm a business owner. My business is, as you said, B2B, maybe it's service business, maybe.
Yeah.
So maybe it could be a construction services, it could be marketing services. We don't have a lot of hard assets, so we're not a manufacturing company, and we don't have a lot of inventory, maybe.
Right.
Okay. So we're not retail
Right.
or something. And we want to grow. We want to working capital infusion. So what does that mean? We need more cash to run the business. So that could be a line of credit.
Could be.
Or it could be just like a conventional loan. You were
Right.
saying those are
And again,
kind of common.
the most important thing, and any small business owners, bankers should know the difference, is what is the payback on the investment that you're making in the business. If it's a long-term payback, you want to build staff to open a new division. Well, you're going to have to, hire, you're going to have to pay payroll for that staff until that new line of business is starting to generate returns. That's a long-term investment in the business. That's something that should be financed over, 5 years. Even with the SBA program, they'll allow the bank to do even a longer term payback. That's a long-term investment in the business. If you are carrying receivables, but you've got, in a service business, you've got payroll every 2 weeks. You're owed the money, but you don't have the cash. That's where it's a short-term bridge between when you sell your product or service and when you collect the cash from it in a B2B scenario. That's a line of credit. That's short-term finance. Unfortunately, a lot of my peers out there don't always structure the loans to match the purpose and or the payback period.
So if you're a business owner thinking about how you might capitalize growth, you could consider conventional loan or line of credit, but just be clear with your own intention of why you're doing it. And then that should lead you to the conversations with a banker to get the right product. Is that
correct? Absolutely correct.
Okay.
Because what oftentimes happens is bankers love to sell lines of credit to small business because they're variable interest rates, so the bank doesn't take any interest rate risk. But what happens is if that's a long-term investment in the business that you're using that line of credit for, when it does come time to fund payroll because you have billings outstanding you haven't collected, you've tapped out your liquidity. One of the horror stories in lending that we see a lot of this and end up restructuring it for the business owner is, I use the funds for my line of credit to grow my business, But now I have a short-term working capital need. I'm tapped out. And oh, by the way, when that bank reviews your line of credit and see it doesn't revolve up and down like it's supposed to, then they term it out and all your liquidity is gone. So very, very important. One of the key points of financing is matching the structure of the loan to the purpose of the financing and the repayment period.
Excellent advice. Thank you for that. Now, on the SBA side,
Yes.
if we're looking to grow the business, you made a couple of recommendations. So for businesses that might not be a startup, it could be a
Right.
startup, but might
Right.
not be, SBA could be a good fit because it might not fit some of the conventional lending standards.
Right.
Is that right?
Yeah, and it could be, just the type of business is not hard asset intensive. So that secondary source of repayment, which banks are typically looking for to backstop or shore up their risk in terms of hard collateral in a service-based business, isn't there. So the SBA guarantee can basically substitute for hard collateral in service-based businesses. It could be, you're acquiring a business to grow your own. And, what's the biggest part of a business acquisition financing? The goodwill, right? The blue sky, the intangible value of the business. Well, that doesn't give bankers a great comfort level, again, from that collateral perspective. So the SBA, guarantee can be employed to allow those transactions that make good business sense and have good cash flow returns, but don't have that second piece of the credit pie, which is the collateral. It can be a great option.
Let's talk about collateral for a second, because I think it scares a lot of owners to think about, oh, wait, I have to put my house as collateral, or what is collateral most commonly in these scenarios?
So it's really it's based on the risk profile of the business. I mean, if you have a strong cash flowing business, a lot of banks, including us, will lend on that history of cash flow. And that's when, good cash flowing, good profitable businesses, they're very competitive from a banking perspective. So you don't want to be too onerous on the owners themselves to pledge collateral outside of the business. So I always say, when your business is at that point, you have the leverage. When you're starting out, or you're falling way outside of the cash flow parameters of business, the banks kind of have the leverage and might require some additional collateral outside of the business. So in a strong cash flowing business, usually the business assets themselves, even if they're not strong enough to support the loan from a collateral perspective, banks will do conventional financing in those scenarios. The challenge has been, in today's world, it's not as bad as it was, but when we came off of the COVID years, a lot of businesses really got beat up in terms of their financial performance because of all the restrictions in certain types of businesses. We're getting out of that phase now, where 2020, 21, even some cases 22, maybe the numbers weren't there to support conventional financing. But now we've got 23 and 24 and interim 25. There's more conventional lending on a cash flow basis available now. But when we were coming out of those few bad years of earnings, a lot of banks were leaning on the SBA and other or extra collateral or other ways to mitigate their risk.
So if your business is not strong cash flowing, that could be a reason why maybe the loan won't work out either, correct?
It might not work out conventionally, but if, at least in our shop here at Enterprise, if you can show us trends that you've, recovering from that and your trends are going well, and you can give us some reasonable projections for where you expect to be, and, some semblance of a business plan. I don't need a full-blown business plan for a business that's been in operation for 20 years, but what are you going to do to improve the business? That might be a good business decision for the bank to invest from a lending perspective, but it doesn't have that traditionally strong, several years of solid earnings. That's another scenario where we might bring the SBA in to mitigate some of that risk, but still allow the business to finance its growth.
Gotcha. I talk with bankers offline, right? And
Yeah.
you're the first banker I've had on the show, but I've talked with bankers all the time for my clients, either on the buy side or the sell side in a deal. And especially with SBA, it's very interesting because it is kind of a black box. And I think there have been some recent changes in policy over the last year, maybe even recently with the OBBBA law that's gone in, or the act that's gone into effect. So I don't usually timestamp these shows, especially for this conversation. I want anybody to be able to pick up this episode and listen anytime. However, because there are some things that are probably worth noting that might be new or different for people to
Sure.
be aware of, is there anything of note that you would share that's kind of a change to SBA policy and how they view lending?
Yeah. So let's go back a few years. We had kind of tried and true underwriting guardrails and parameters and eligibility criteria in the SBA program that had been in place for 20 years. All the lenders knew the parameters. There was, even though this is SBA lending, which is, traditionally higher risk for some reason, for some aspect of the credit parameters, that you needed that government support. But there were very clear guidelines. What happened in the last administration was a lot of those guardrails were relaxed to try to get money into the economy, different reasons, political reasons, whatever. And what we saw for the first time in the SBA program was that, particularly with the emergence of fintechs that got involved in SBA lending, where it had always been just kind of the traditional banking system, we saw some of these lenders take too much advantage of the relaxation of the criteria. And for the first time in a decade and a half, the SBA program actually cost the federal taxpayers like you and I money. So when the Trump administration came back in, they needed to get this program back to what they call a zero subsidy, so that it's not costing the taxpayer. It costs the taxpayer money for the administration of the SBA, but not for the loan program itself, because there's fees and there's both upfront fees for the business owner and fees paid by the bank to participate in the program. What they basically did is went back to the old rules, where and again, even the old rules are fairly forgiving versus conventional bank financing. So now we're all kind of back at a level playing field where it's pretty black and white as to what's eligible for SBA, what the underwriting criteria are. There's a big focus right now in the SBA on growing our manufacturing segment. This administration is really big on onshoring manufacturing back in the United States. So there's some new programs that have come out recently targeting manufacturers that still have even more flexibility than the traditional SBA program has, but they haven't continued to give away the store in terms of what lenders can do with the program.
Gotcha. That's helpful. Thank you for that. When we first met, you were talking on a panel about acquisition and acquisition funding, and then afterwards we've had further conversations about the different types of scenarios for acquisitions. And one of the things that I work a lot with business owners on is, well, who's the right fit buyer for you? It is probably a myth that the buyer out there most commonly is a strategic buyer, or the most common is a financial buyer, like a private equity. We hear about them a lot.
Right.
They're in the news, but it might surprise the audience to know that the most common buyer is an insider.
Right.
I mean, by far. I don't know if you have any numbers on that. I've tried to do some research and see if I can get some numbers. I think I've seen something like 70% or something like that in the privately held company market, which is frankly most businesses in the United States, are having a transaction with someone they already know. Maybe they're related, maybe they're an insider because they're management. So I want to talk to you about that, because I think this is another reason why enterprise is a little bit different, right? And kind of how you guys approach things. So maybe you could share your perspective on the insider acquisition play.
Yeah. So it's kind of counterintuitive in some way, that from a lender's perspective, the two primary risks when we're looking at business acquisition financing are the management transition and the effectiveness of the management transition, and then the numbers. right? So, a lot of insiders, whether they be a management team or a key employee or even the next generation in the family owned business scenario, a lot of times they're thinking, well, I don't have the money to buy this business versus private equity, other larger or similar sized companies that do have the financial wherewithal, but don't have that intimate technical knowledge or management understanding of how that business operates. For us as lenders, at least an enterprise bank, I'll take an insider deal all day long over one of a financial buyer because I'm taking one of those risks off the table. Not entirely, because it's still important that the insider has the right skill set. And if they don't have all the right skill set, they've engaged with professionals or other members of the management team to round them out. Those are the scenarios that, the business transition, management transition risk are minimized because you have people that are already involved. The problem is those folks, in a lot of cases, don't have the financial wherewithal that a true financial buyer, like a private equity company or another company, might have. I would rather see a business with leverage without the management risk transition than someone coming in with a lot of cash that has no understanding. Now, I'm being a little facetious. If they're in the same industry and they're competitors, they understand the market, then they're coming in to buy a business. They understand the marketplace. They might understand the customer base. But I'm talking about a purely disinterested third-party financial buyer versus an insider. The money coming into the deal is less important I believe, and based on long-term experience, the money coming in is less important to the ongoing viability of the business from a management perspective. That is one of the great scenarios where SBA can mitigate the financial side of the transition, but the management side of the transition is much less risky.
That makes a lot of sense. When you mention criteria, the resume sounds like it's a key part of that. Maybe you could elaborate on some other criteria that you're looking at.
Yeah. So as again, kind of going back to my most recent comment here, I mean, we want to know whether it's a key employee or whether it's a management team, what are their roles in the business? Where are the gaps? Where is the owner leaving a gap? I really like the deals where the owner or owners have transitioned day-to-day operations to their management team for some cases years, and they're not actively involved in the business. That's even less risk. Scenarios where the owner is still actively involved, the key is who has the skill sets in the management team to assume that responsibility. And if they don't, can they get professional assistance? Can they make a strategic hire to round out that particular aspect of the business that maybe the new ownership team does not have? So assessing people in an insider buyout, people and their competencies is key. Outside of that, we're always looking to make sure that a new ownership group, whether they be insiders or outsiders, is getting a reasonable value in relation to the purchase price. So we do take a very deep dive into business valuation metrics. Matter of fact, in the SBA world, SBA requires a disinterested third-party business valuation that has to support the purchase price. So, core competencies of the new management and ownership team, valuation reasonable in relationship to the buyout price. If we are financing a lot of goodwill, even with the SBA program, the commitment of the new ownership team, and you talked a few minutes ago about, pledging houses and pledging outside collateral. One is mitigating the collateral risk, but the other is a commitment. Put your assets where your mouth is, so to speak, in terms of committing, your personal wealth to the business transition. Now, the practical side of this is once the business has established itself with the new ownership and management team in place post acquisition, once that cash flow, if that cash flow or that profitability or whatever financial metric you're using, when that is proven post-transition, it becomes, again, a very competitive conventional loan deal. So a lot of people have heartburn about, pledging additional personal assets as collateral. I explain to them, under the SBA program, there are no prepayment penalties. So once you are bankable under the new ownership management structure, all those bells and whistles go away, or that SBA lender is going to lose that relationship to a conventional bank. So SBA, I always looked at as a transitional product. It's not a long-term solution. It's to mitigate risk to a point where you become bankable conventionally.
The term bankable is interesting. I use that term with some clients, catches them off guard because they don't think about if they're not bankable, right? As a
Right.
business, that's the other side of it. If you're not a bankable business, you're not going to be able to get a line of credit, an LOC, or a conventional loan, and it shocks them. There have been conversations I've had with some banks that even say, well, these are industries we tend to stay away from because we perceive them as higher risk. So I think a footnote on all this entire conversation is it's just so helpful for business owners to take a look at their business, maybe as a banker would, right? Where are the risks in your business? So if someone's going to lend you money for your company, kind of ahead of time, what are some of the things that would be a reason that would, be interesting to a banker, like strong cash flow, things of that nature. If you're looking to acquire a company and you're seeking capital, if you're looking to increase working capital and seeking those types of loans. And then if you're looking to acquire a business, let's say you're an individual entrepreneur, acquisition entrepreneur. I talk to a lot of those folks who are interested in finding the right business, being a succession solution for privately held companies, maybe baby boomers that do not have a successor in place. And so they're coming in from the outside and they're using SBA as a mechanism for buying the business. That's kind of one use case. The other use case is the insider using SBA for a way, it may be with other lending mechanisms like seller financing and other things. Those can come into play. But we do see a very interesting application for the management teams and call it non-family members as a mechanism for buying. I think with family members, there could be gifting strategies. I mean, there could be gifting strategies with management as well. We're talking, of course, about a lending mechanism. And so conventional and SBA, we see as a strong potential. This is super helpful. I guess, as we start to wind down the conversation, as you think about the audience of business owners, and we want to try to help them think ahead. I think you've given a lot of food for thought. How would you coalesce? What are 3 things that you want them to take away?
Yeah. So first of all, I did want to talk about kind of the flexibility, particularly with the SBA program, talking about that financial capacity of a buyer. For an insider buyout or even an outside, third party, you can essentially get 90% financing. SBA on they call it change of ownership transaction. The SBA minimum equity injection is only 10%. That's a lot more flexible than on a conventional business acquisition lending scenario where you could be 30%, 40%. And actually, it can go as low as 5% if the seller is willing to hold financing for a portion of the non-financed acquisition, as long as they provide flexible repayment terms that fit within the SBA parameter. So, kind of going back to your question, don't think that because you don't have hundreds of thousands of dollars to invest as an insider or an outsider into a business acquisition that you can't qualify for financing. So, again, it's really a people-based approach. So that would be the first thing. First advice is don't think you cannot acquire a business just because you're not personally wealthy. If you have the right skill set, you have the right knowledge of the business or the industry, there's great flexibilities there. The second thing is, if you're coming in as a disinterested third party, some of the best scenarios that we've had great success is that individual will immerse themselves, if not in that business themselves, They might work in it as an employee specifically with the idea of they want to learn it so that they have the opportunity to buy it and with a good understanding of it. Or they'll immerse themselves in the industry to at least understand that side of the equation. So the second piece of advice I would have, if you're interested in a particular type of business, learn it, work in it, work in the business itself, work in a similar business, understand as much as you can about the inner workings, at least of the market that you're going to operate in, if not the business itself. Probably thirdly, in a business acquisition, if you don't have that cash that we talked about, and it can be fairly reasonable in an SBA scenario, be prepared to put it all on the line from a commitment, outside collateral perspective. I mean, yes, banks are traditionally horrible at liquidating collateral. What it's worth to the bank is not what it's worth to you, whether it be real estate or equipment. But the commitment to taking over and running the business successfully is very, very important to lenders. And don't think that's a long-term play. If you do well, the tables turn all the time. You have the leverage then. You have other banks competing for your business. But when you're in those higher risk scenarios, the worst thing for me is say, okay, I want to buy a business, or even I'm an existing business that doesn't fit traditional credit parameters, but I want to grow. But hey, my assets are my assets outside of the business. That doesn't give me a great warm and fuzzy as to the commitment to the business. And in our model at Enterprise, which is very, very different from any other bank that I've been exposed to through my SBA career, we actually take a personal financial stake on the upside and the downside directly out of our compensation. So we have skin in the game at this bank. We want the owners to have skin in the game, but we're also realistic. When the business has proven itself, we'll drop SBA guarantees. We'll get rid of houses as extra collateral. We'll convert it into a conventional loan when our risk is reduced. Probably the last piece of advice that I would have for anyone interested in acquiring the business is get professional help. You don't pull off a business acquisition without a good CPA, without a good attorney, without a good insurance person, and in a lot of cases, without a good strategic consultant. Kind of like, no specific plug for you, but I'm going to make it anyway. There's a lot of professional coaching assistance, business transition assistance available through your company and others. Surround yourself with the professionals. This is not something at any reasonable level that someone can pull off on their own without help.
Yeah, that's great. Great advice. I love the summary. Dave, we have covered so much ground, and I'm sure people are going to want to follow up and learn a bit more about you and about the bank and your process. What's a good way for them to do that?
Yeah. So, our website, enterprisebankpgh.com for Pittsburgh. We're Pittsburgh born and bred. We've been in business for 27 years now. I've been at the bank for 22. Most of our staff has been here 15 years plus, which is also a big anomaly in the banking industry. We don't have the revolving door that a lot of banks do. And then we also have an ecosystem here. So we provide bookkeeping services to small business outside of the bank. We provide IT services. We provide marketing services. We provide podcast services. This is the studio we're in right now. So we've tried to develop an ecosystem that supports small businesses beyond the financial tools that we provide at the bank. So enterprisebankpgh.com. You can hear a little more about the bank and learn about some of our customer stories and small business resources through Inside the Vault, which is our podcast series. We're tucked up here in the North Hills. We lend all over Western, Central PA, Eastern Ohio, Northern West Virginia. So happy to talk to any of your viewers or listeners.
Amazing. You're a wonderful resource. And the Inside the Vault episode where I am a guest, everybody needs to tune in and watch that or listen to that on their favorite platform. Dave, this has been amazing. Thank you so much for hosting me at this studio. This has been fabulous. This is literally only the second time I've been in person with my guest in 5 years.
Yeah, it's great for me to be on the other side of the table. I'm usually sitting in your seat. So this has been awesome.
Well, it's fabulous.
Appreciate the partnership with my business with Business Sherpa and you person.
Oh, well, thank you. No, I really appreciate you. And to all of our listeners, thank you so much for joining us on Succession Stories. Be sure to like us, follow us, and of course, leave a rating and review and subscribe to us in your favorite platform and on YouTube. You can catch all of our videos and all of our web assets there on Business Transition Sherpa on YouTube. So Dave, my guest today, my host here in this amazing studio. Again, catch us next time on Succession Stories.